Sunday afternoon. Hope everyone's doing well and staying safe. So I'm not going to give a background on Bharosa Club. If you want a background, you can see it in some of our prior videos. What I do want to spend a little time covering is some of the things that are in the pipeline, because I'm really pleased to be seeing member feedback come in. That's really what's going to make this club fulfill its mission of empowering all our members through understanding. So it really makes me feel great that members are coming in with, hey, I want to learn about this or that, or whatever. So a couple of the topics that we're going to create videos on and papers on. So the first is we're going to create an ad hoc video on what's happened with the Franklin Templeton debt funds. So this is a very confusing issue for a lot of people, an abrupt, closure of funds, etc. So we're going to cover what happened in very simplistic terms in a video. And that'll be available for both members and non-members of the club. So that the best way to basically see that video is become a subscriber on YouTube, and you'll be able to see when that video is uploaded. And then the second thing that I wanted to update members on, and this is just for members of the club, but we've done detailed research reports also, which are now available under the Learn tab and clicking research. So the first research note is available, and it discusses our current view on what are the attractive sectors given the economic climate that you see around us. So you can expect more pieces like this. We think they're really useful for sparking thinking around your own portfolios. And we'd love to hear specific feedback on that so we can also refine our own thinking around these issues. So we're also going to be doing a detailed research report on basically the various options people have on debt funds. This is a question we're getting from a lot of people right now. So we're actually going to sit down and analyze all the facts and lay it out and lay out our recommendation in a thought piece. So I know people are looking for feedback on that. So stay tuned, that's coming. It'll come later this week. So just give us a little time to organize it. Okay, great. So with that, you are joining us for part 3 of stocks, Zero to Hero. We're going to start getting into some financial analysis in this class, so it'll be exciting. The first time we'll crack an annual report and see what fundamental stock analysis is really about. And the complexity level of the classes is going to ramp up from here on out. So please feel free to use Q&A to cover anything that I didn't explain clearly in classes, because it's going to be harder and harder for me to anticipate what's going to be confusing for people. But with Q&A, we'll be able to address and iron out all those issues. So great, let's kick into the presentation. Okay, so we're gonna do a very brief recap of what we covered last time. So first of all, congrats guys, you've come a really long way in only 2 sessions. We understand the conceptual underpinnings of stock investing. And that may seem like a very small thing, but it's actually a tremendous achievement, because a lot of stock investors do not really understand these things at an intuitive level. So we've done that, and that's a real testament to kind of progress we're making here. The second thing we covered is that the most useful measure of price when you're looking at a stock is the PE ratio, not just the quoted price that you see in the market. Why is that? Because when you buy a stock, different stocks give you different earning streams in return. And so to really compare how cheap or expensive a stock is in the market, you need to not only take into account what you're paying to get the stock, you also need to take into account what you're getting back in the form of earnings. So the PE ratio allows us to compare the two and then compare prices across stocks. We also learned where the E comes from. So what earnings really are and what happens to earnings. And as we learned, some companies pay those earnings back to investors, some reinvest them in their business going forward. We also learned how we do financial analysis and what our main tools are for that. And we saw that we can get them all for free. So, this is a great sort of thing. You have all the tools you need at zero cost to start making good investing decisions in your portfolio. Okay, so now let's figure out what we're going to do today. So initially, I'm going to again stay grounded in intuition, because Once we understand what something is, then we can play around with complexity beyond it. So first, we're going to intuitively understand what the income statement, balance sheet, and cash flow statement are. Then I'm going to introduce to you the company that we'll be analyzing. So Anita has already sent on chat the annual report for the company we're analyzing, which is Britannia. I encourage all of you all to download it. It's optional for this video series, but we're going to be using this annual report from here on out. So you might as well download it and start reading through it on your own also if you want to, start familiarizing yourself with it. But that's also optional. And then we're going to conclude today by beginning our analysis by dissecting the income statement and understanding it in a little more detail. So we have a pretty comprehensive class today, so let's get started. Also, as a reminder, if you get Q&A, don't wait till the end, just send your Q&A in the chat and we'll review the Q&A at the end. Okay, so let's start with what an income statement is. So first of all, as I mentioned, finance is full of jargon, and this is no different. The income statement is known by several names. One is income statement, the other is profit and loss statement, and the last is P&L. So anytime you hear these statements, they're all talking about the same thing, which is an income statement. So what's the best way to understand what an income statement is? Well, if you've ever sat down and made a budget for yourself and looked at the past, right, to help you make your budget in the future, you've probably written down all your income, right? So it could be your income, your wife's income, some investment income that you have, some FD income maybe, right? You've written down all your income categories, you've totaled them up, and then you've written down all your cost items. So for example, your tuition fees for your children, you may be sending them to chess classes. So the cost of that, your housing cost, your vehicle cost, et cetera, et cetera, et cetera. Then you total up all your costs, and the delta between all your income and all your costs gives you what your net savings are at the end of the day, right? So a company does something very similar in the income statement. A company looks at all its income and all its expenses, and it calculates the difference between those things for a period. And that gets us to the earnings of the company. So the income statement is that analysis. It allows us to trace how income turns eventually into earnings. And that's why it's such an important part in the analysis we do. So specifically, what can we do with the income statement? Well, the E from the PE ratio comes from the income statement. So we'll exactly see where that earnings number comes from, and we'll actually calculate a PE ratio in today's class. Secondly, we can understand the inner workings of a business. So one thing is understanding the bottom line earnings ratio. As many of you probably already know, you can simply get an earnings ratio from Google Finance or Yahoo Finance or Bloomberg, or there's so many places you can just pull an earnings ratio. But when you look at the income statement, you can actually understand where those earnings come from and how those earnings are derived, which is very valuable for understanding a business deeply, which is what you need to do when you invest in a business. And the last bit is, ultimately, what are we trying to do as investors, right? We are trying to make an educated guess about the future earnings of a company. Now, it's very difficult to predict the future, but the best guide to predicting the future is the past. So if we can understand the past and what's happened in the past, it allows us to predict with better certainty what's going to happen in the future. And the income statement allows us to do that. So proper understanding of the income statement is going to allow you to make better judgments about a company's earnings. So that's why we really care about this financial statement. Okay. So what is a balance sheet then? So you guys may have heard the term net worth. You may have actually calculated your own net worth. So what are you doing when you're calculating your net worth, right? You're looking at all the things that you own, and you're subtracting out of that all of the things that you owe, right? So for example, I could have, some money sitting in a bank account that I own that money, it's mine. right? I could own a car, that's also mine. I could own a house, that's mine. So I'll write all these things and say, I own all of these things. But then to calculate what my actual net worth is, I also have to subtract out all those things that I owe other people. Maybe I borrowed 10 lakhs from my father, right? So I have to pay that back. Maybe I have a mortgage on my house, so that also I have to pay back, right? Maybe I borrowed for my car, so I have to also take that out. So when you're calculating the net worth, you're taking what are all the things you own minus what you owe, and you're left with your net worth. How wealthy are you at that given time? So a company does something very similar in a balance sheet. It also, on one side of the balance sheet, you'll see all the things that it owns. And on the other side of the balance sheet, you'll see all the things that it owes. And the delta in that is also called net worth for a company. But again, because finance is full of jargon, net worth is also known as shareholder equity, book value, book equity. There are lots of names for it. But I'll show you where exactly you can find this number. And it basically tells us how how much cushion there is for the company and how much wealth it has to buffet any sort of unexpected events, etc. So why do we care about this? So the balance sheet essentially tells us how a company funded itself, and that allows us to make determinations about how risky it is. So if you're watching CNBC these days, one of the things you're probably hearing a lot of market pundits talk about is that you should be investing in companies that have very strong balance sheets. Why is that the case? We've gone to this analogy a couple of times, but it's the best way to really understand this. Consider two people, right? One that has lots of savings and net worth, and one that is living on a razor's edge, which has very little savings, right? In times like this, where you have an unexpected job loss or whatever, which one's in greater risk of going bankrupt? It's obviously the one that doesn't have a lot of net worth, right? So same thing happens with the company. So when you're looking at the balance sheet, you're trying to understand, what does this company own? How much did it borrow? And how much does it have tucked away for a rainy day? So proper balance sheet analysis will allow you to make better judgments about the riskiness of a company. So if you remember, proper stock investing is one, about future earnings growth. Two is about the risk involved in investing in the company. So this helps us with the second piece of the analysis. The last statement, and this is the one we're going to use the least, is the cash flow statement. So the cash flow statement basically helps you trace what happened to the earnings generated by the company. So remember when I told you that there are different things a company can do with earnings? So the cash flow statement allows you to see a company generated this much in earnings. This is how much they paid out in dividends. This is how much they reinvested in the business. So it will allow you to understand what a company is doing with the cash it's generating. Are they reinvesting it in the business, or are they returning it to shareholders? And it will allow you to understand the nuances of how cash moves in the company. So at an advanced course, we'll delve a little more deeply into the cash flow statement. On this course, I'm just going to walk you through some of the key things you need to know to make sure you're factoring the right things in for a basic analysis on it. So that's the cash flow statement. Okay, so as you've probably figured out right now, we're going to be looking at Britannia together. Now, why did I pick Britannia? This is not because I think the stock necessarily is a buy or a sell or anything. Don't read anything into that. We'll all come up with our own conclusions after this course, and it'll be interesting to see what you guys think. And then I'll let you know what I think also. We are looking at Britannia together for the following reasons. One, it's a simple company. They don't engage in lots of different business lines, and they're not a conglomerate doing 150 different things. So it's a pretty simple business. We are all customers of Britannia. If you're living in India, you probably have Britannia products in your cupboard. So that's always nice. If you're a customer, then use the products. Then you understand the business on a very intuitive level. And the third is it's fun. I mean, this is a brand that we all know. And the reason I picked this is it's very much in line with how we think about learning here. The first thing to do is understand the intuition and then move to more complex businesses thereafter. So for those that aren't familiar with Britannia, maybe there's some international people or whatever on the call. Britannia is one of the leading food manufacturers in India. Its products include biscuits, breads, cakes, rusk, and dairy products. And it does sell outside of India as well, although the bulk of its sales are in Indian markets. Okay. Now the source material that we're going to use is the FY 18-19 annual report. So Anita has sent this as a link in the chat, right? So for those that want to follow along, they can. That's totally optional. You don't need it for this video. We're just sending it in case you want the report. Encourage you guys to read it on your own also later. So already off the bat, there are a few things that you can sort of take away from the annual report. One is the report is for fiscal year 2019. So the fiscal year for Britannia ends on March 31st. So March 31st, 2019 is the end date of the report, which means it covers a 1-year period from March 31st, 2018 to March 31st, 2019. So at this point, the annual report is about 1 year old, right? It's stale. And this tends to be the case because annual reports are only issued once a year. So Britannia should be releasing its next annual report pretty soon. But we're in that gap period now. So you may have heard me in the last class mention quarterly reports. So quarterly reports allow us to fill in the gaps between annual reports, right? So right now, Britannia has 3 quarterly reports also. We're going to ignore that for this class because I really want to focus on understanding the income statement, but later classes we'll use the quarterly reports also to figure out what Britannia's financials look like closer to this period. Okay, the next thing is that if you even look at the cover of the annual report, you can understand how Britannia is positioning its business. And this is a topic we'll get into more on future videos, but I just want to tune you guys in a little bit to this topic now. So you can see it says years of success in bakery here. And it says, now let's reset to be a total foods company. So that's telling you something interesting, right? And this is what good stock investing is all about, finding those details that other people may miss. So this is the cover of an annual report. A lot of people won't even read the cover. They'll just open the annual report and go straight into the numbers. But here we're already understanding some important things about the company's strategy. They view themselves as being pretty dominant in bakery, right? They've had years of success. And they're saying, now let's reset to be a total foods company. So we already get the sense that Britannia is trying to expand from dominance in bakery and moving into other adjacent product categories. So as we start developing our framework, we're going to read more of the annual report to understand the management team strategy. And then as investors, we'll have to ask ourselves, do I agree with that strategy? Do I think Britannia can do it? Are there risks to the strategy, et cetera, et cetera, et cetera? So always look for these hidden details in the annual report. Okay, so let's now go to the income statement. So this is on page 48 of the PDF. Okay, so if you've downloaded the annual report, you can flip to page 48 to see where we are. So basically, here's the P&L. So first of all, we understand here that it says statement of profit and loss. So again, here it's saying that they're calling it a profit and loss statement, not an income statement. As I discussed, the two are the same. So that's the first observation. The next thing I'd like you guys to see is this circle here. If you can see my pointer right here, that reveals to us some interesting information. First, it says rupees in crores. So unless noted otherwise, the numbers that you're seeing here are in crores, right? So that's also something that different companies will report in different units. If it's a small company, they could even report in lakhs, right? So you should always look to understand the units that they're reporting. The second thing that I'll alert you to is we have two columns of information, right? There's this column here, which is 2019 data. And we have this column here, which is 2018 data. So almost all companies, when they report their financials, they'll give you multiple years at one shot. So this makes your comparisons easier. You can understand trends more easily. So here we're getting 2 years of data at once. So this is great for our ability to understand the business, right? The next thing I want to alert you guys to is notes over here. Now I know this looks scary, okay, but don't worry, we'll dive into all these numbers on the next page and explain the key way to think about them. And the other thing that is your greatest ally in analyzing companies is these notes. If you ever find a line that you don't understand, right, or you want more details on. So let's, for example, take this line here. Okay, there's this line here that says other expenses. I know you probably can't read this. I'm reading it out for you because the font is small. There's a very big number here. So it's 2221.05 crores worth of this expense. Now that's a very big line item and it's got a very vague name, other expenses. So if I wanted more detail on that, I would turn the annual report to note 33 and I'd get a breakdown of it, exactly what's in the other expense lines. So the notes are a very important part of the financial statements. The last piece I want to alert you to is the holy grail. It's the earnings per share. So this is the E for the PE ratio. This is exactly where it comes from. So you may go to Bloomberg and you may pull the earnings per share. It's not going to be no different than this earnings per share, right? So this is the source of that data. So we'll cover shortcuts and all later, but when learning, it's really important that you understand where exactly things come from and not take shortcuts too quickly. And you can see that two earnings per share numbers. The one we are interested in, and you probably can't read it, but I'll read it for you, is diluted earnings per share. And I'll discuss this later, but basically diluted includes things like stock options, etc. when you're looking at the share count, which is important to do. So always use diluted share counts and earnings per share. Okay. Now, I'm going to take this confusing mess of numbers and help you understand what's going on a more simplistic level where we can start drawing conclusions, okay? So if I go to this page, hopefully the numbers and fonts are large enough for you to read. I've basically taken exactly the same data from the other page and I've just formatted it so it's easier to read. And I've also grouped the expenses in buckets that make sense. And these buckets will give you an insight into how a stock analyst looks at companies' income statements, okay? And the most important thing is the individual lines will differ for every company, but they'll all look very similar to this. So this framework should be able to be repeated for any company you look at, pretty much. The exact nomenclature, some people may call this line X, some people may call it Y, that'll vary, but these buckets will not change. So if you use the notes and you try to put the income statement in these buckets, you'll be able to have no problem with it. Okay, so let's go through the buckets. So the first bucket I created out of the income statement on the other page is I looked for all of those lines that looked like they were income for the company. Right? So money coming into the company. So what were those line items? Sales of goods, income from operations, other operating revenues, and other income. Okay. So those are all clearly inflows into the company. So this tells me how much is coming in. It's like when you make your budget, you calculate all your income streams, right? So we're doing the same thing here. So that's bucket A. The next bucket I looked at was what are all the costs that directly go into manufacturing the products that the company sells. So think of these as direct costs. If I'm selling Nimbu Pani, this is the cost of water, sugar, limes, and glasses, right? To sell my Nimbu Pani, right? So these are your product costs. And the name we typically use in finance for this is costs of goods sold, which makes sense. It intuitively is the cost that you're of the products you're selling. So the line items I picked up from Britannia's income statement that account for this are cost of materials, right? So that's the cost of raw materials that they purchase. Excise duty, which is a tax that people pay on manufacturing. So that's also part of making goods. Purchases of stock in trade, which is also basically purchasing finished products, not raw materials, but finished products that Britannia uses. And changes in inventories of finished goods, right? Which is also related to how much they have in inventory of raw materials and finished goods that they're using to produce the products you have. Now, don't worry, these words are confusing to you now. Like I said, if you go to the notes, they'll explain what these lines are, and you'll be able to see, does this belong in bucket B or does it belong in bucket C? The next bucket of costs that I included together are those that relate to the business costs, the overheads of running a business, right? So think of this as marketing expense, advertising expense, paying salaries for your office employees, your rent expense for your office, right? All those electricity costs, they're not directly related to producing the product, right? They are, in a sense, support costs. So these costs I grouped into other operating expenses. So that's bucket C. Below that is bucket D, which is funding costs. So these are called finance costs here. This represents costs that Britannia is paying on money that it borrows from other people to run its business. So if they take a loan and they need to pay interest, the interest on that loan will show up here. And the last is taxes to government, right? So the taxes to government is obviously what they pay the government for the profits they generate. So if you take A, which is the income, minus the costs in bucket B, minus the costs in bucket C, minus the costs in D and E, you're left with the profit for the year. And that's the net earnings that come to the business. So there are also a few terms you may hear for earnings. One is earnings, one is profit, one is net profit, one is net earnings, right? And then one is net income. All of these things mean the same thing. Again, finance tends to have lots of names for the same thing. But the general flow for the income statement will always look like this. Income at the top, costs to produce your products following, costs to run your business following that, finance costs following that, taxes following that, and then your earnings at the bottom, because we're trying to move from income to earnings. Then I have my shares, right? So these are the total shares outstanding. So all of Britannia's shares, so they have 24 crores of shares, right? So if I divide the profit for the year by the shares, I get my earnings per share in rupees. And that is exactly the number I use for my PE ratio. And you'll see that that matches exactly on the last page. So you can calculate this earnings per share yourself if you have the total profits for the company and the number of shares. Okay, so why did I bucket these numbers like this? The reason is these categories tell me something very different about the health of a company when I'm looking at a company's financials. So the first bucket is pretty clear. If I know how much a company is getting in income and how that's changing over time, I can basically see, is this company selling more and more of these products every year? Do customers really want this product and want it more and more every year? If they do, that's great. If they don't, okay, then we need to look a little closer as to why, right? So that's why I bucketed all the income together. Why did I bucket all the costs of goods sold together? So the key here is businesses that tend to be very valuable to their customers are able to charge higher prices, right? So let's take my Nimbu Pani example again. if I had a Nimbu Pani stand and I was the only Nimbu Pani stand outside of Gateway, I have a monopoly of sorts, right? I'm the only option for someone that wants a cold beverage. So they have no choice. They can't go to someone else. So if my Nimbu Pani, let's say, costs me 5 rupees a glass to produce, I can maybe charge 15 rupees per glass, and people will still buy my Nimbu Pani, right? So my cost of goods relative to my sales will be a very low ratio. I'll be able to do a very high markup on my products. Now pretend another guy came in and he started selling kulfis, right? And another guy came in and he started selling coconut water, right? Suddenly I've got competition. I can't charge 15 rupees because people will buy the other products. So I have to lower my prices. So by looking at the ratio of cost of goods sold to total income, because total income is the selling price, right? Cost of goods sold is the cost of my Nimbu Pani, right? If I look at the ratio of those two things, I can assess how much pricing power a company has. The more pricing power it has, the lower the ratio of cost of goods sold to my sales should be, my total income should be, right? So that's why we like this line item and we look at it that way. The next bucket we had was other operating expenses, right? So why do I care about this? Well, it allows me to see how efficiently someone is running their business. If I have lots of expensive offices, in the fanciest buildings, and I'm giving lots of perquisites to my employees, company cars and private jets and all those kind of things, I'll have very high other operating expenses. If I'm running my company very leanly, cheap offices, not overspending, then I'll have very low other operating expenses. So it allows me to see what kind of business efficiency a company is doing. So, and then obviously, why do I care about the earnings per share? Well, at the end of the day, that's what I'm buying when I'm buying the stock, future earnings per share. So I can look at the earnings per share and I can see how they're growing historically, and then I can make a judgment of what's going to happen in the future. But key to making my judgment about the future comes back to these three blocks. How much do I think their sales will increase? That'll tell me about income. How much do I think they can increase their income? How much do I think they can retain their pricing power? Is the market going to get more competitive and therefore their cost of goods sold will increase faster than their sales because they'll have to lower prices? Or do I think they'll be able to increase prices over time, in which case the cost of goods sold will grow slower, right? Or do I think they have a lot of bloated offices and they can reduce the bloat and increase their business efficiency, right? So these will be the tools I use to forecast earnings in the future. And we'll do some of this as our next step in going deeper into Britannia. But first, we just really need to understand these blocks, and we'll start using these blocks in the future classes. Okay, so I just wanted to conclude this class by calculating a PE ratio for Britannia. So to put and basically tie the first three classes we did together with this class, all three classes together. So, I have my earnings, right? We calculated it on the last page. So now I just need to get the price. So I pulled a Google Finance chart of Britannia share price. Now remember, our annual report is a year old, right? So the earnings is a little old. It's not been updated for the quarterly earnings. So I didn't take the current price. I actually went back a year and I grabbed the price around that time, which coincidentally was a very similar price to where it is now. So a year ago, Britannia's price was about rupees 3,000 a share, and their earnings was 46.68. So all I need to do is divide the two, and I got 64 times. So Britannia a year ago was trading at a 64 times PE ratio. So now you see how all of this kind of works. It's not magic. These numbers come from the annual report and the price of the share. Okay. So and to conclude, before we go to Q&A, I'm just going to basically tell you where we're going from here. So in the next class, we're going to learn about using growth rates and margins and other ratios. So when I was talking about comparing costs to sales, basically what I'm talking about are margins. So margins are a very powerful tool in stock analysis. They allow you to make conclusions about the health of a company. They're simply ratios that carry a lot of important weight. So we'll discuss those next time. We'll also look at growth rates and how we can use those to make conclusions. We'll do similar dissections of the balance sheet and cash flow statement that we did of the income statement, so we understand those. And then we'll figure out how to use these financials to start drawing conclusions about Britannia that we'll investigate together. So we can ask the right questions and we'll figure out how to answer those questions. So a lot of interesting stuff in the pipeline. Hope you join us for our next class on Sunday. And as a reminder, do keep a lookout for our video on the Franklin Templeton funds, which will be probably coming in a few days from now. So that'll hit our YouTube channel. We're not going to do a seminar for that. That'll be more a standalone video. And for members, keep a lookout for our research reports. I know a lot of you have gone through them already. Thanks for sharing feedback on them. And yeah, look forward to tackling a lot of things with you guys. So just philosophically, you can expect two kinds of videos from us, right? And two kinds of content. One is around education, general education. Two is around current events. If we see things in the market that we believe are confusing and not well explained, that's an opportunity for us to come in and have a seminar or a video on to explain it in very simple terms that are understandable so that people can make better decisions for themselves. So encourage all of you, please let us know if there are topics that you find confusing, that you want us to cover. This club is meant to address those concerns. So with that, I'm going to open it up for Q&A and then we'll conclude.
Okay, so the first question that's come in is, it almost seems that competitive income statement analysis is extremely important, or at least equally important. Comparative year on year and comparative with other companies. I mean, how do you comment on that?
Absolutely. So that is a fantastic observation, and it really foreshadows where we're going to go in the future. Looking at a static piece of numbers, right? There's very little you can sort of divine from that, right? I mean, okay, I know a company's earnings growth for 2 years. What does that tell me, right? If I look at it over 5 years, right? And if I look at it against its competitors, I start to form a picture in my head that is much more robust. Is Britannia doing better than Hindustan Levers? Is it doing better than Nestle? Is it doing better than Dabur? You know, if it is doing better than companies that look like it, that tells me something, right? So you're absolutely right. Where we're going with this is looking at this data over longer periods of time and versus competitors that do similar things. So we can draw a conclusion that, look, it looks like Britannia has some real brand power. People don't want any old biscuit. They want Britannia Bourbons, right? Or maybe we'll reach the flip side conclusion saying, no, it looks like the brand is deteriorating. People are less willing to pay for Bourbons than they were before, right? So that's the kind of stuff that we're going to do. So great question. You're absolutely right.
Okay, so the next question is, how will I be able to know if earnings of my company are good or bad, or the costs are too high?
Yeah, so another great question. So a lot of that will come from the competitive benchmarking. It's going to be very hard for you when you first start to understand what a good margin is, what a bad margin is, because you will not have a lot of reference. Think about, let's say you're buying a house for the first time. You're not going to know the market prices, right? Intuitively off your head. But if you're a real estate broker, you know all of them pretty well. So initially when you start out, it'll be, you'll have to do more competitive work also. You'll have to look at the income statement of companies that look like your company and then compare them. And that's how you'll be able to see, is this company out of line, in line, or better than average, right? So that's how you'll do it.
In the Britannia example, we looked at data which was 1 year old. How do we calculate a more current PE ratio?
Yeah, good question. So we'll get to this in future classes, but essentially we'll rely on the quarterly statements. So like I said at the beginning, in between annual reports, every quarter the company comes out with updated income statements and balance sheets. So we'll use the annual report and update it for the quarterly reports. And that'll give us a rolling earnings number that we can use for our analysis.
Okay, so there's a question, when calculating the net worth, should I subtract the entire loan I owe or only subtract a part of it which is owed in that year annually?
Good question. You should subtract the entire loan because even though you may only owe a portion of it in this year, contractually, if you read your loan agreement, if you don't pay the rest of that loan, then you go into default, right? So you have to pay that loan. And when you're calculating net worth, you're less concerned about what you have to pay in 1 year and more concerned about, okay, these are all the things eventually I have to pay back. And maybe even in 20 years, right? But if you were to sell the company, let's take the example of a house. That's a good example, right? Let's say that I own a house, right, for 1 crore, okay? A flat for 1 crore. Let's say I have a loan of 80 lakhs on that house. That means that if I sell this house today, what is the net amount of cash I will receive? Well, I'll get 1 crore when I sell the house, right? But I have to pay back that loan, that 80 lakh loan, right, first. And I'm left with only 20 lakhs, right? Similarly, that's what we're really after in a balance sheet. We want to know if I were to take all the assets the company owns and I were to sell them and I were to pay back all the money it owes in the future also to its creditors, what is left in the bank?
Okay. Should we compare the ratios to the industry average? And is a simple comparison to the industry benchmark a sensible approach?
Absolutely. It's a very sensible approach. So when I was doing investment memos, for my seniors at Apollo and my hedge fund, right? A core piece of our investment documents would be competitive benchmarking, where we do exactly what you said. We would list out all the companies we thought were good competitors, right? And we'd analyze the key numbers for each of them, right? Not in as much detail as we'd analyze the company we're looking at, but we'd do a quick analysis to see how it stacked up, right? So don't worry, this is not going to be as fulsome an analysis we'll do for competitors. We'll be able to do it relatively quickly. And I would then calculate exactly like you're saying an industry average. And I'd list out the individual competitors as well as the industry average and then my company at the bottom. So you could see all the information in one shot. You could see this is where my company is. This is how it compares to the average in the industry. And this is how it compares to all the players that I'm using to calculate my average. And that'll give you a very good understanding of how it compares.
Okay, so there's a question. The PE used is the trailing PE, but stock analysts work on future earnings to benchmark a stock's benchmark price.
Yeah.
How is future earnings calculated?
Yeah, so we discussed this a little bit in, I think, the first video. You're right. A lot of analysts use future earnings to calculate PE ratios. I'm not a fan of this. And in Apollo, we never used analyst numbers because analysts, only they know how they calculate their numbers, right? So if you use a forward number without understanding where that forward number came from, you have no ability to see is it right or wrong. So really what you need to do is create your own forward number, right? So that's why I'm focused on trailing numbers here. I think particularly as a beginner, you should always look at the past as your guide for the future and never take someone's point of view as what's going to happen in the future as sacrosanct. Analysts have gotten a lot wrong. And it's not good to give them 100% credit for what they're doing.
Okay, so there's, is PE ratio the most important when buying a stock compared with similar industry? Okay, is PE ratio the most important factor when buying a stock?
Is it the most important factor? That's a tough question. I mean, it's one of the more important factors. Let's take an analogy. Is price the most important factor when buying a flat? I would argue that it's not the most important factor, right? Because if it were the most important factor, then shopping for a flat becomes pretty easy. You buy the cheapest flat you can find, right? Similarly, buying a stock becomes easy. You buy the cheapest PE ratio you can find, right? I would say it's subtler than that. The most important factor is understanding the relationship between the PE ratio and the inherent value of the company. Which is why there was a really good question in the last video, I think, where a person asked, should I look at the PE ratio first and then do my analysis, or should I do my analysis first and then look at the PE ratio? I think it's always good to do your analysis first and then look at the PE ratio. You will not be biased by the PE ratio then. If you see a high PE ratio, you won't automatically think, oh, this is a great company, right? The best way to do it is do your work. Say, I think this PE ratio should be, 30 times. Then when I look at it and it's 50 times, then I say, hey, that doesn't make sense. I don't want to be in the stock. So the most important factor is, how does the PE ratio compare to how good you think the company is? And that's how you make investment decisions.
Does the net sale per share matter for stock choosing?
Not very much, but for a particular type of stock. So for companies that are very high growth, that do not have earnings, so tech companies, for example, right? A lot of times you'll see them with negative earnings. Now, why is that? Because they're investing so much in the business that they're not actually making money because they're trying to grow very fast. So for companies like that, when we do valuations, because they have no earnings, we look at sales, right? Because what is that company promising? They're promising to grow their sales, then revenue, their income so much that at some point they'll be able to make lots of money. So in circumstances like that, your net sales can be used in valuation. So yes, price to net sales can be a factor, but not very frequently. And especially in India, most of the companies that we have that are listed are more mature companies. So I would steer you away from using that unless there are no earnings and this is a tech company or a startup or a very high growth company.
Okay, where do we get the industry average? What's the source?
So you can get the industry average, like IIFL, for example, publishes industry averages. There are various sources. I'll do some digging to see a good one. I've used IIFL's industry average in the past. I'll send a link around. Mama, just note who asked the question.
Okay.
You can send the link to them. So my view on this is, when you're looking at a stock, it's better just to calculate your own industry averages. Because if you know where the numbers are coming from, you know all the subtleties in it, it is a little bit more work, but that's my bias. But a lot of people also use shortcuts.
Okay. I think that's it. We've covered all the questions. If anyone has questions that may come up later when you are reviewing the video maybe, or just thinking this over, please feel free to send them on advisory@bharosaclub.com, and the video will be there on the YouTube channel.
Yep. Great. Thank you guys, and see you next Sunday, and keep an eye out for those other points.